Hey folks, the pricing of credit is critical, and in this country we have had a significant evolution. If you walk a little back, we had KBRR from about 2014 to 2016. We had the cap on interest rates from 2016 to 2019, after which we have had risk-based pricing upon which each bank had its own unique base rate. Now that is being overhauled, and that is being spearheaded by none other than the market regulator, the Central Bank of Kenya. We want to make sense of this and what it means for the economy because of the criticality of this subject, and we are privileged to have the man in charge, the Governor, Dr. Kamau Thugge. Thank you for your time.
Thank you.
Karibu sana.
So,
Doc, let's start from, let's walk a little back. When we first got an indication from the Central Bank on this matter, there was intimation that the Central Bank was of the view that the quest for a unified base rate should have been anchored on the CBR. Ever since we have seen a rethink of that, we're now on the interbank. Just walk us through that evolution and why this is particularly important for the economy.
but maybe just to take you back a bit further, you mentioned the issue of capping of interest rates. Yeah. And as you know, interest rates have always been a very sensitive part of the economic discussions. The public has always been concerned about high interest rates, and it's because of this that the interest rate caps were introduced in 2016, as you said. Now, of course, the capping of interest rates was supposed to generate more credit to the private sector from the banking system. But as you know, the exact opposite is what actually happened. Before the caps, we used to experience credit to the private sector of sometimes at least 20% growth. But with the introduction of the caps, we saw a huge deceleration in the banking sector credit to the private sector to the extent where sometimes it was below 3%. And so by 2019, it became clear that this system was not sustainable and that it needed to be changed. And in preparation for that, the central bank with other stakeholders came up with the banking sector charter, which essentially had 4 pillars. First pillar was to address the issue of the caps, which was to come up with a new risk-based credit pricing model. The second was to make customers at the center of banking operations. The third was to introduce transparency in the setting of rates. And of course, the fourth was to entrench ethics and integrity in the banking sector. So the central bank took the lead in coming up with a new risk-based credit pricing model. And essentially, it included 3 key elements, or 4 key elements, I would say. One was the cost of funds. The second was the cost of providing loans. The third was shareholder return. And the combination of these 3 were what would have been the base rate. But you see, that base rate was different for each commercial bank. And then each commercial bank were to add a premium or a credit risk factor to that base rate, and that's how they will come up with the lending rates to borrowers. So, so that is a system that has been in operation until this new framework. In its operation, we realized there were some major shortcomings. One, as we just agreed, there wasn't a common framework, and therefore it was not very transparent. And at the same time, we realized that it was biased towards the banks and against borrowers. And the reason I say this is because when it was necessary to raise rates, when inflation was very high and the exchange rate was unstable, we took the decision to raise rates to stabilize prices and to stabilize the exchange rate. And for sure, the banks followed very quickly. They raised their rates very quickly. And ultimately, we were able to stabilize prices and stabilize the exchange rate. So when that was achieved, and we felt that now we need to pivot towards increasing credit to the private sector, get growth started and jobs creation, etc., When we lowered the CBR, it took some time for the banks to lower their rates. Indeed, there are some banks where their lending rates, is the same now as it was when we started lowering the rates. So we felt that this is not fair for the borrowers, it's not fair for the customers, but it looks very good for the banks, because when rates go up, they benefit from high rates. And when rates are going down, they don't lower the rates. And so we felt that this needed to be addressed. The other thing that we needed to address was the effectiveness of monetary policy transmission. And for the same reason, the banks were not lowering their rates when the CBR was coming down. We felt that we were not able to achieve the objectives of the Monetary Policy Committee decisions, where when we lower the CBR, it will be expected that commercial banks lower their lending rates so as to stimulate demand for credit and get the economy going. And therefore, we came up with a paper, we circulated to the public, we got a lot of comments from the banking sector, from the private sector, from international development partners. And then we came up with a new, with a new framework. So the new framework starts off with the anchor of the interbank rate, which is really the cost of funds. Then each bank will then add a premium. And what we are saying is this is a very versatile framework, because it doesn't have to be that the banks are adding a premium. They can also be reducing. In other words, you can have, if you have a very good customer and not much risk, maybe even their loan is backed by deposits in your bank, you can decide to say your loan will be Kesonia -1 or -2. If he's a very high risky person or borrower, it will be Kesonia +3 or +4. And I think the beauty with this new framework is the transparency it brings to the system. Because every Kenyan knows that when they go to the bank, they will have the same common reference rate for all banks. And all they need to do is look at this K, the K that is put on top of their reference rate. And I think by being able to publish that K for all the banks, everybody will be able to see whether Bank A is adding a K of 2, a K of 5, a K of 7, and thereby be able to go to the bank that is charging the least based on their risk profile, and obviously on the loan product that they are looking for. So it introduces a lot of transparency. In addition to that, it introduces that it levels the playing field for the borrowers and for the banks. Yeah. Because this time, the way it will work when we lower rates, especially given our new monetary policy implementation framework, where we try to ensure that the interbank rate is very closely tracks the CBR. But where we are saying that this now makes a difference is that when we now lower the rates, we know that the banks will also lower the lending rates to borrowers. So just a couple of things. One is, as I said, the framework applies to all loans except the foreign currency denominated loans and fixed rate loans. Second, the implementation, the transition. We have agreed to have a 6-month transition period for existing loans. I think this is important to have that transition. In the previous framework, we didn't have a timeline. So that even though that previous framework came into operation in 2019, there were still some banks that where we had not reached concluded on the type of model that they will be using in terms of pricing their credit. But this one, with the existing loans, we give you 6 months to come up with a framework. If it's a new credit, what is saying with a new credit, we are given a maximum of 3 months. But in the meantime, banks should, in fact, if I was a CEO of a bank, I would try to move to this framework as quickly as possible. So the sooner you get the board approval of the model, then immediately you can start using that model for the new credit. But by 3 months, all new loans must be based on the new framework. For the existing loans, by 6 months, then you must transition to this new framework.
All right. Good intro there, Governor. I have a question on the interbank. As you would know, Governor, the interbank as an indicator itself is not without blemish. We're in a market which periodically has skewness in terms of how liquidity is posturing in the market. And this has implications as to where the interbank market rate is playing. How does this impact the Kesonia introduction? How will that affect the pricing of credit?
Well, I think we have a fairly deep market now at the interbank market. There is quite a large amount of transactions taking place in the interbank market. And I think the divisions we had before between maybe tier 1 and tier 3 banks are not relevant as much anymore. So the Kesonia is just another name for the interbank rate. We're just renaming the interbank rate. So the interbank rate, to call it Kesonia. And as you know, this is the naming practice even in other countries where you have the SOFA and you have the Sonia in the UK. So the framework that we now have, the monetary policy implementation that we now have, requires us to ensure that the interbank rate closely tracks the CBR. So right now we have the CBR at 9.5 until the next monetary policy meeting. And so therefore, between now and then, the interbank rate, or Kesonia, we say, will actually be stable, will actually be reflecting where the CBR is. So even as we go forward, the way I see the transmission is the Monetary Policy Committee meets. It looks at the data, what was the inflation rate last month or the last 2 months, what are other central banks doing with their interest rate? Is the exchange rate stable? Let's lower, because the inflation is below 5%. Let's lower the CBR. So because we want to now stimulate credit to the private sector, which, as you know, has been very low. Although it has, there's a turning point, and now we've seen, as of July, we saw credit to the private sector increasing by 3.3% compared to negative 3% in January. So we are seeing a turnaround, but I don't think that is sufficient. We need to get more. So when we now lower the CBR, we would now expect the Kesonia to go down by the same amount that we lower the CBR. And that all loans, because we have a now common denominator, or common reference rate for all the loans, that all loans would also come down by the same amount as the Kesonia and the central bank rate.
Okay. Governor, on that point of the adjustments on monetary policy, you've been very instrumental in the introduction of the corridor that anchors the interest rates and how they play about. We are introducing the new risk-based pricing model in an environment of an accommodative monetary policy stance. And in the recent developments, you really squeeze the corridor to really play within a very tight margin, if I could call it. What happens if inflation starts ratcheting up? We see FX pressures, and you begin to widen that corridor. How does it now impact the pricing of credit?
Okay, two things. I don't think that the fact that inflation starts to go up, that we need to widen the corridor. We don't need to widen the corridor. What we'll need to do is raise the CBR. And as we raise the CBR, within the same, having the same corridor, the 75 basis points on either side. Once we raise the CBR because of the inflationary pressures, then the Kesonia also would automatically go up, and the lending rates would also automatically go up and immediately, and that will affect now aggregate demand much faster than was happening with the previous framework.
Is there any further guidance that the CBK is giving banks as far as the K is concerned? And this is why I asked that question. Banks, as we all know, posted themselves differently depending on their risk appetite. I could be retail focused because of the kind of risk profile of my clients. I look at risk in a different way. Is there any further guidance that, because there's a concern out here is there might be an overweight consideration of that factor, especially if you're looking at the retail focusing banks?
Yeah. I think just to emphasize, this framework is not about controlling rates. And as I mentioned earlier, when we try to control rates, the opposite of what we wanted is what actually happened. Instead of getting more credit to the private sector, we got less. And so K, we want to leave it K for the banks to determine for the same, if it's, for example, if it's a loan, let's say a five-year loan with a tenor of 5 years, would expect if we have the same risk rating, me and you, and we are in the same bank, and we're trying to get a loan for 5 year with a 5 year tenor, that rate should be the same. What they charge you should be the same as me. But if your credit risk is higher, then obviously the bank will charge you a higher rate compared to me. So we do want to leave the K to be determined by the banks, and we've also said this is a framework that is very versatile. You can have K to be 1, it can be whatever number you want. It can also be negative, as I said earlier. Yeah.
Okay. One of the things which has really started debate, given the announcement by the central bank around the new formula, is the variation between the simple average versus the compounded in arrears. And if you could just help us understand why you took that decision of the compounded in arrears and what it means for transmission.
Yeah, I think we took compounded arrears because that reflects the true market cost. And we did look at the pros and cons of just a simple average and the compounding in arrears. And the international practice is actually to do compounding in arrears, and that's what we and essentially I think that is what that's what we agreed. And for those who may be not in this particular area, compounding in arrears is where you add interest on top of the principal and you charge interest on that, and you continue to compound. So yes, so that's international best practice, and I think that's it's for that reason that we chose to go in that direction.
Governor, 3 or 4 monetary policy cycles before, the central bank introduced on-site inspections to monitor how banks are actually transmitting the decisions of the Apex Bank towards final borrowers. Should we expect that to change under the new risk-based pricing, or it continues as it has been?
I think it will change very significantly. we did on-site inspection of all the banks, and those inspections were really to see how and whether the banks were following their credit pricing models. And the results were not very encouraging, and this is also part of the reason why we are overhauling the whole system. And in fact, even though some we had agreed on the model, some of them were not following the models. And of course, now we're in the process of assessing whether there will be penalties and how much penalties there will be.
Okay. Governor, closing my conversation about the new risk-based pricing model. If you unbundle it, one of the components, of course, is the cost of operations for the banks. I would have expected that that would be pegged on the best in class and not necessarily each bank's operational cost. And the reason why I thought that way was because effectively an inefficient player could basically be transferring their inefficiency to the cost of borrowing of ordinary Kenyans like you and I. Don't you see a challenge there, Governor?
I would look at it a slightly different way. We start off with the same reference rate, Kesonia. You happen to be inefficient. Yeah? A bank with, you have a lot of costs and happen to be much more efficient. Yeah. I would therefore imagine that I would be more competitive. I would offer borrowers a lower interest rate than you. And therefore, I think then consumers or borrowers will come to my bank rather than go to your bank because your rates are higher. Your inefficiencies are being translated to higher lending rates. So I think it would be difficult to come up with a best-in-class kind of costing. Let the banks determine the K. It is now very transparent to borrowers what K is being charged by each of the banks. Let banks compete on that basis on having as low K as possible.
Yeah, well, my final question on this point is this debate emerged online, and when I chimed in, I was almost attacked because the argument has been that the new framework will bring lending rates down, and I've said no, it won't. It will only enhance transparency. And pegged on that, because of the competitive nature of Kenyans, you'd be able now to nudge prices downwards based on competition. Is that a correct position, Governor?
That's correct. The introduction of transparency, I think, will give more bargaining power to borrowers to be able to even shop for the best rate. But I would also say this: under the old framework, and indeed under any framework, we know that when rates go up, the banks always raise their rates. What is new with this framework is that it at least addresses the other side. So it makes it symmetrical that when now rates go down, borrowers would now experience that reduction in rates. So it may not be that the framework itself is going to result in lower rates, because that will depend on the situation of inflation, the exchange rate, etc., etc. But what we are now addressing is the other side for the borrowers, that when rates come down, let also the borrowers benefit from the lower rates, which was not happening before.
All right. Governor, I only have one more question. And that is with regard to the fact that the central bank did float a tender around an OTC market for bond trading, focusing on the retail side. And I was very curious about it. The reason being, the central bank is the agent of the government in raising domestic debt. Here you are, you'll also be having this infrastructure in place. What are the constraints that within which the central bank looks to be playing in this space, and also how soon do you intend to be rolling that out?
I think we're just going through the procurement process now. My hope would be that we're able to complete within this financial year, yeah, and to have that retail bond. And I think, remember again, will be mobilizing resources for the Treasury. So it's not like it's a bond for us. It is still to mobilize, just like any other bond, is to mobilize resources to be used by the Treasury to fund their operations. I think it's just part of really deepening the financial sector. I keep saying, last year we funded the government to the tune of 850 billion. I don't think we've ever done that before. And we did it in a context where even interest rate, the treasury bill rates and bond rates actually came down, notwithstanding the fact that government borrowed quite a significant amount of money. And I think going forward, the situation going forward is that official development assistance is declining. Of course, we had some challenges with even some of the bilateral and multilateral lenders. There are some difficulties in mobilizing revenues. And so, and there's still need for infrastructure spending. So we need to have a deep market where the government can also rely on the resources here without driving up interest rates and crowding out the private sector. So I see going in towards having a retail bond as part of that deepening of the financial market. Of course, also improving on and increasing financial inclusion. But I do hope that we are able to put that in place before the end of this financial year.
All right. Yeah. Allow me one last question, Governor. Article 4 consultations with the IMF, to the best of my recollection, or to kickstart in September. Any update?
Yes, there were supposed to be Article 4 consultation discussions in September. Our preference had been that we start program negotiations in September before the Article 4 consultation discussions, so that we move the Article 4 discussions further down, but we start with the program discussions, and perhaps once we have concluded with the program discussions, then when the program goes to the board, then you could have the IMF board consider both the program as well as the Article 4 consultation discussions.
We've been having a conversation with the Governor of the Central Bank of Kenya, largely focusing on the new regime as far as risk-based pricing is concerned. Of course, we shall keep monitoring this to bring you the details as and when they unfold. Keep it NTV.